welcome. Let's now start our first lecture on financial instruments. We're not going to go into this in depth, guys. There's going to be plenty of financial instruments in second, third year and postgraduate studies. I'm just going to work through a very basic high-level overview and one type of financial instrument from an actual accounting perspective. That's in line with the course. So in the next lecture, you'll see that there is a little infographic that is exactly this page in front of you. And in that infographic, there will be 3 dots. They're all red ones, and those will give you the exact definitions of the following 3 items. So first of all, what is a financial instrument, right? A financial instrument is going to be a contract which infers an agreement, right? Usually an agreement that is legally enforceable, but an agreement nonetheless. And with that contract, it will give rise to a financial asset for one party to the contract and a financial liability for the other party. That's as simple as it is. But then you need to go and look at what is a financial asset. In terms of your previous week's worth of work, we know that any asset is a future economic benefit. But financial assets go into a little bit more specific type of detail now, right? Now, financial assets are going to either be cash, either investment in another company's equity, so shares. So we aren't issuing shares, we're buying someone else's shares, right? Or there is a contract to receive cash. So those are kind of the 3 that you're going to need to think about. Okay, so in terms of contracts to receive cash, there might be a loan receivable. You might have lent someone money and now they have to pay you back. You have a contract in place and you have a right to receive cash back. Also, your normal invoicing process, if you sell on credit, that's an agreement, guys. Someone has to pay you. Your client has to pay you, so you have a contract to receive cash. Okay, that is quite nice and easy. Then financial liabilities. We realize liabilities are obligations, right? They are future outflows. So we have to pay something or give up an asset in order to settle this obligation in the future. Now, in terms of an obligation, here, I want you just to think about any liability whereby there is a contractual obligation and that contractual obligation is to deliver cash or another financial asset. Now go and have a look at the infographic. It's nice and interactive, and the exact definitions are there for you to learn, write them out. But you're not going to be tested on the theory here in this exam. You're going to be tested later on the workings. Let's get the theory out the way now, right? So some examples of financial assets: investments in listed company shares or private company shares. You go buy shares in Anglo American, that is a financial asset to you. Trade and other receivables, it's a contract to receive cash. Sometimes we call that debtors, right? Loan receivable, also I could own the debentures or bonds. Those are types of debt instruments. So a company will go and issue debt to get money, okay? And what's going to happen? You, as the purchaser of that debt, the debenture or bond, another name for a debt contract, guys, you are going to get repaid the money later on, right? So that's a financial asset to you. Financial liabilities, trade and other payables, we often refer to that as creditors. Long-term debt or loan payable, where you have borrowed money today and you have to give it back in the future, right? So you might be the issuer of debentures or bonds. Those are fancy names for loans, guys. Don't worry about the names being fancy. Accounting for financial assets, last bit of theory. Initial measurement, okay, on day 1, when you buy a financial asset, how do you measure it? At fair value. 99.9% of the time, that is going to be equal to cost, okay? So just know, on day 1, measure it at fair value. Then I just want you to remember that you've got to identify in a situation whether you are the holder, okay, or purchaser, right? Same thing. You're the person after that date who's going to hold that piece of paper, that contract. Or if you are the issuer. Remember, if you're the holder or purchaser, you'll be dealing with a financial asset. If you're the issuer, you will be dealing with either liability or equity, right? After this, subsequent measurements. So after day 1, day 2, day 3, 1 year down the line, what do? Well, either you're going to be in one of two models, either the fair value model or the amortized cost model. And there we're going to talk about classification. There'll be slightly different types of financial assets and liabilities. Now, you don't have to worry in depth about that. That gets dealt with in second and third year and postgrad studies. It's quite complex. Okay, so that is underlying theory. Have a quick look through the next interactive infographic. Then we're going to do the journals with you and do an example. Thank you.